Okay, good afternoon, guys. Before we start, as always, we do our customary instant poll. Just check everyone can hear my voice correctly. We'll put it on your screens now. So just let me know if the sound is perfect, too loud, too low. Just give me an indication if everyone can hear me. Okay, just any kind of indication at all. Is anybody? Yep, well, I've got one perfect so far. Has anybody else got any other thoughts? So we're just going to continue with that, the one perfect, unless anyone else is two perfect. All right, okay, that's great. Thank you, guys. All right, what we're going to talk about today is an introduction to channel trading. Now, before I start, a risk warning. Now, spread betting and CFD trading both carry a high level of risk to your capital, the possibility of losing more initial investments. These products might not be suitable for all investors and are only intended for people over the age of 18. Please ensure you're fully aware of the risks involved and, if necessary, seek independent financial advice. So again, the views and comments in this presentation are not the views of InterTrader. The provision of this information should not be construed in any circumstances as recommendations or solicitations to buy or sell any security or financial instrument mentioned herein. InterTrader assumes no responsibility for your trading result. Okay, so trading channels. Now this is based on the observations that the tendency of financial instruments are set and maintain a certain direction for a period of time. So really, when we look at any kind of chart over any real kind of time period, we're going to see some sort of trend evolving. And that might be an upward trend if we're in a bullish market, might be a downward trend if we're in a bearish market, or there might seem to be no real kind of decision at all, which we call a sideways market. So again, this is where we find defined limits where we reach support on the lower end and levels of resistance on the upper end, and the price action has moved between them. So really, how we describe trading channels is in all of these three aforementioned things, we're just going to have two parallel lines, one on the support level, one on the resistance level, and this is where the price action is going to move between. So again, if we apply this into our trading strategies and how we trade our entry points, it can be quite a powerful tool. So we have the ascending, like I said, which is where it's on the lower end on the left-hand side that moves high on the right-hand side on your graph, and that means that's an ascending, that's a bullish movement. Descending, where the price starts on high on the left-hand side of the graph, moves to low on the bottom right-hand side of the graph. That's again a descending, so that's your bearish market. Again, if you look in the stock markets, especially, we're going to see good examples of downward markets and sideways. And again, this is where it doesn't really kind of exhibit particular slope or bias. It just really moves between these 2 points and moves in a sideways manner. So the types of channels. Now we have a diverging sideways, and this is best described by a combination of rising tops and falling bottoms, such as the price action diverges, yet the overall kind of pivot and the median point of the chart stays relatively the same. Horizontal, this is where your support and resistance bands are parallel to each other, but there's no kind of real slope. So again, it's just two trend lines that go straight across the highs and lows of the graph. Now your consolidation, it's a combination of your rising tops and your falling tops and rising bottoms, but the price actually really kind of converges towards the pivot. So you might actually get a point where the two lines meet and we get some equilibrium there. So this is a great example of a sideways channel. So again, what we see is a bit of a fall at the beginning of the graph. Then we see it kind of like we see some support come in at this point in the graph, and we do see the market bounce back up. There's no real direction, and then as we see, as it starts to come down towards this lower end of support again, we see a very nice pattern emerge, and we do see it peak out on the upside, break through the resistance here. But as you can see, there was a real kind of emphasis to try and push up. We see a bit of a, well, I suppose a hammer or doji type formation form here, and then we see again real negative selling till we get back into the trend, and it touches right back down onto your bottom line of support. So again, when the market doesn't really seem to be doing much, and it's just moving in a bit of a sideways manner. Maybe we've had some information come into the market which has made the market go down. Then the market's reassessed and thought the market, the particular news wasn't as bad as we thought, so we break back up early in the graph. But then really, there's no kind of decisions in the market being made at all. So all we'd look to do is buy anywhere along this line of support and really kind of sell it on anywhere it kind of like touches or even slightly breaks through the level of resistance. So again, even when you've got a market where some users come in and filtered through and it hasn't really changed the price action too much and it hasn't given the market any real overall bias. So what we can see is we maybe have, again, this could be, 5, 10, 15 minute chart or whatever, but we're going to have 1, 2, 3, 4, 5, 6, maybe 7, 8, 9, 10, 11, maybe 11 opportunities to buy along this level of support and sell it, for a reasonable profit. Now again, the great thing with trend channels is that we don't have to just buy. We can buy, sell, turn and reverse, sell back in because we know the likelihood is at the top when we do hit these levels of resistance, they're going to hold. So again, we could buy, sell, buy. Okay, I'm not going to say be able to do that 11 times and reverse 11 times. But no, if you take, this into account with your other indicators, you take into account perhaps with some volume, perhaps take into account with some other, if you know the downside level is particularly strong at this point, and the resistance isn't so strong, what we just do is, again, we look to buy anywhere along this line and sell anywhere, on the top line of resistance. But as again, we can't be too greedy as traders. We have to go with other indicators, maybe our oscillators when we see the market's overbought or oversold, and we only buy or sell at them points. But again, with a graph that isn't really giving us any kind of real direction, maybe, in that time period here, as you can see, we have 3 or 4 good opportunities to either buy or sell. So really, if we're going to tie that into our trading strategy with our other indicators, for a graph that's given us nothing, we've actually got 4 really good reasons to trade and 4 opportunities to make money. Now, this is an example of an uptrend. This could be anything. Let's use gold as an example. We know that gold is a target price around $2,000 an ounce. It's probably hit it, or it's probably very close to that at the minute. But again, we're in an upward trend. What we're doing is plotting our level of resistance on any kind of peaks of the graph, and our levels of support on any low peaks of the graph. So again, that gives us a nice price action to kind of, to put the upward movement into, and it gives us boundaries. So again, it's not perfect because we see a bit of a breakthrough here on the bottom side. But then again, here, we could get anywhere long after the selling's has stopped, and we've moved back into our trend channel here. So we could buy anywhere along here. And again, we don't see any retracement. So that's a really good opportunity. Yet again here, perfect. Hit the bottom level of support, follow it up, and you'd look to get anywhere out where we start to peak, get towards our level of resistance on the top end. So again, we can't be too greedy. If we're going to look in an upward trend, we really should be buying all along our support level and selling all above our resistance level. So again, I wouldn't look to sell on an uptrend. People can. Again, I can't tell you how to trade. I'm just saying that you're going to have a lot more success buying in an uptrend because A, the market's expecting to go with you, which means you get the volume, and which means you won't get the pullbacks and have to take much of an offside position. And also, using the example of gold, and we know there's a real finite target to hit, then that's giving us the overall real kind of direction of the market, giving us the overall emphasis, and it's all self-fulfilling. If we know the likelihood is that gold's going to hit 2,000, and we're getting in round about $1,900, $1,950 for instance, we know we've got a $50 real kind of opportunity to make that difference because we know where the market is expecting the overall price to be. So that might take a day, it might take a week, it might take an hour. We don't know. Okay, sorry guys. Mark's just saying the sound's breaking up. Does the sound okay for everybody else? Don't want anybody to miss anything. Okay, just anyone just give me an indication they can hear the sound correctly. Nish, Sai, anybody else can you all hear the sound correctly, guys? Okay, yeah. Okay, Mark, well maybe just check your sound settings, maybe check your speakers, or your headset, whatever you're using. Everyone else seems to be hearing it okay. Okay, great guys, thank you. Cheers for the feedback there. So again, that's the example of the uptrend. Think about the overall market. Think about the self-fulfilling prophecy, right? If people think the price is going to go up, we're in an uptrend, then just look to buy. Look for low points in the graph. Look for points where we're going to see some value in whatever commodity stock or indices we're buying. Then go with the overall trend. Then again, don't be too greedy. When we start hitting the top end of the trend channel, the levels of resistance, maybe take some out. See what happens. Take some profit there and then, because again, we always know there's going to be any bounce backs. We know exactly, or we're hoping we know exactly where it's going to go back to our level of support. So plotting a channel. Now, really, just drawing parallel lines with a naked eye is one of the best ways to do it. Now, when I say this, we can use the more complicated ways of, mathematically plotting these channels. But again, when we talk about the self-fulfilling prophecy, and I talk about the market's move because everyone's looking at the same thing, if you can draw a line in that fits quite accurately, and you can do it across, the bottom levels of support and the top levels of resistance, if you can draw that with a naked eye, that means so can anybody else. So if other people are drawing in these lines, then again, by the very nature of the markets, people will be looking for these to hold for support and bounce for resistance. So if we can draw these lines in, then again, it means anybody else can, and it makes them more likely for the market to accept them. So again, we look at like these very, very complicated ways people, set their indicators up, and maybe they've got 10 graphs with, Bollinger Bands, moving averages, slow stochastics, all these kind of complicated things. That's great, but they're less accessible to the market, and people don't use them as often as you think. Basically, the basic things people use are your moving average, trend lines, and the direction of the market. So if you try and keep, your graphs as clean as you can, and you don't get too distracted, if you draw things in like trend channels and trend lines, honestly, they really are going to be a lot more powerful for you to trade from, because other people will be drawing these trend lines in as well. So it just makes them more likely when the market sees them for them to react in the way of the overall trend. So if we're in an upward market and we've all drawn in the same level of support, it's more likely to hold than if you've got, some 50-day moving average with Bollinger Bands and, whatever else, fancy stochastics you want to put on it. Remember, you're trading against other people. So there's going to be other people of all sorts of abilities. But again, if we're all looking at a common thing, it's more likely that these things are going to happen within the market. So again, we can plot channels in a slightly more technical way. Now these are basically broken down into 3 ways. So you've got your standard deviation channel. Okay, this is 2 lines that form a standard deviation and the parallel to the linear regression of the trend line. So in fancy terms, that just means that it's 2 parallel lines, that are exactly the same level apart. So again, these are usually set to standard deviations of the regression line. So again, they're just an equidistance apart on the graph. So you got your standard error channel. So your standard error channel can also be used in place of the standard deviation. It's preferred by some investors, but really, again, the standard deviation, in the square root, is based on mathematical, formulas. It's based on, mass as its core. So that's why it's exactly, equidistance apart. Now we've got another one called the RAF channel. So this is the distance between the channel lines and the regression line. And it's the greatest distance that any one closing price is from the regression line. So again, sounds very complicated, but it's not. This is basically just shows you the upper levels are based on mass and the previous movement in the previous bars, but how far a possible move could be. So again, it's just based on the highs and lows, and that then plots on the low side your low levels of support, and on your high side your high levels of resistance. So again, they're all based on mass. They're all based on the previous formations of how the market's gone, how the market's moved. So again, that's just going off volume, buying and selling price action, and just making an average, and basing 2 lines based on mass around that average. So this is just how you'd see it. So if we see the line in the middle would be your midpoint. So that's what things are going to be calculated against. So that's basically taking an average of your high points on your standard error lines, which are your reds. So these are really your high points in the graph, and again, equal your low points in the graph. So that's how that's calculated off the average line. Then you've got your RAF channel, which again we can see is just hit on the low side, but we don't really see anything kind of hit on the high side. Then again, we've got your standard deviation. So again, if we're looking for big volatile moves, we could plot all these 3 lines in, and this is how far the market could move outside of our original standard error channel. But really, again, keeping it simple, just use your standard error channel, because that's going to give you, again, 1, 2, 3, 4, 5 opportunities, maybe 6 at a push to sell on the high side, and maybe 1, 2, 3 good opportunities to buy on the low side. So again, I've got the standard deviation. That looks like a good level for stop loss positions, perhaps. Absolutely excellent. Yeah, great observation, Si. Yeah, what we could do is, if we're looking to go short at this position here, then we don't get out, even if we're pushed until this level here, until the RAF or your standard deviation, because we know that this standard error channel is holding up, so we know really how far the market could get pushed against us. So yeah, we can use these, for our stop losses, or use them for an indication of when we're wrong. So again, in trading, it's all very well known when we're right, but it's very, very important we know when we're wrong. We know when to cut out, and we know the reasons why we cut out. So you can use these RAF channels and standard deviation channels to say, okay, well, if it gets past the first point, the RAF channel, and the trade is going against me, maybe it's time for me to reassess, and then get out the trade, see if it hits the standard deviation level. If it doesn't, and it breaks back through the RAF channel, maybe again we keep our overall commitment, our overall thought on the trade, and go short at that level, because we know that it's going to go from here to here at some point, and hopefully the standard error trend is going to continue. It'll break back in and start hitting our midpoint and our low ends of support. So again, it's all about building these things into your trading strategy. Now again, we've traded some live figures recently, and we've had to do things like this. We've had to say, all right, this is a level that I want to go short for this reason, this reason, this reason. I won't get out of the trade until it either comes back to me or goes offside to this point. And that means, we had to hold our trade for 45 minutes, but at no point in that 45 minutes did it hit our levels, of where we thought we were going to get out. But because it didn't hit these levels, we didn't get out the trade. We stayed in the trade, which meant we made 3 times more profit than we would have done if we'd have just got out the trade when we're in profit. So again, when I talk about trading and the best ways to make money, sometimes you have to hold your trades for a lot longer than you think, but actually in real terms, you're taking on exactly the same risk. So again, there's just things you need to build into your trading strategy and how you trade. And these kind of trades within standard error and your RAF and your standard deviation can help you, because what they're going to tell you is that if you are right and you are on side, you don't get out for any reason unless these levels don't hold or they don't seem to fit in your plan. So if you're short here, then you don't get out the trade until at least test your midpoint. And then again, if it tests your midpoint, as we can see, it breaks straight through it and goes all the way down to our lower end of support. So if you're short anywhere here, you don't want to be taking profit anywhere on the top bit until it's at least tested our midpoint. So again, and once you've done that, you're so far on side, and you might have had to wait. See, if you're short here, it goes all the way down. So maybe you think to yourself, okay, it's tested, I'll take some of the profit out. And then you would be wise to do that, because the market goes straight back up, but it doesn't break through our level of resistance here. So maybe you'd have to get your trade here, take it all the way to your level, take some out, or you might even let it bounce all the way back up and then sell again, because we've still not broken through. And then again, never comes back to our entry point. Yep. Then we see some indecision in the market, the trend continue and straight through. So you make double the amount of profit by taking on the same risk. So just because we take it down here and we can take out some profit, yeah, I'd always advise to take profit when you're well on side. So that's a point. Yeah, we know it's going to bounce or break through. So we take some profit. We let the rest of the profit come all the way back, still taking no risk because we've taken profit and we're not offside. Because our entry point is here. It goes all the way down, back up, back right through. When again, if it starts to break through here, maybe you're positively average because we've held that trade for so long. So we put double our trade on, wait for it to hit our levels of support, and that's a really good trade. Take some profit initially. Let some profit ride back. You've got back into, you stayed in the trade, you've got to your midpoint, you've averaged in positively, and you've doubled the amount you've made in that trade. There are different ways to trade it, but I'm just saying that'd be the perfect example of how you trade it. You've got all the confidence in the world that when you get in here, the likelihood is that it's going to hit your midpoint, and the likelihood is within time it's going to hit the lower end of your standard error channel. So again, these are just good things you can build in and build your stop losses around them. But again, you have to look at these kind of things because this is how other traders assess the market and assess, again, especially when markets are volatile, how far they can peak and go against you, right? So really good indicators, as Si said, for your stop losses. So building a trend channel into your strategy. So again, instead of using off-the-shelf strategies, we can really kind of customize our own trading strategy around it. So I've just given you a perfect example of how we've traded around that standard error channel. So really, all that is a midpoint, a series of highs which could continue on a fixed line, and a series of lows which can show support on the bottom end. So what this is going to help you, right? It's going to help you time your entry point. So you don't get involved unless A, that your level on the low side has hit some sort of support and bounce and was heading towards your at least your midpoint. So that's how you can time your entry. And conversely, on the top end, if you're going to sell into resistance, if it hasn't broke through the resistance line convincingly and it's starting to come off, that's when you'd sell. But also, it's going to help you exit the trade. It's going to give you something to aim for. So your aim point is always your margin, so your midpoint. So that could be, you can tie that in with the moving average. You could tie it in with the midpoint of the channel. So that's going to give you somewhere to aim for. So unless your trade starts to come back to you and go offside, you don't get out, or you don't take the bulk of your profit out until you've at least tested the midpoint. So again, it's going to help you with capital management because it's going to let you stay in trades longer. Maybe you don't trade as often because, again, you're not going to get involved until the extremes are hit or you're at the top end or the low end of the channel. And as Si, again, rightly pointed out, you can use the RAF and the standard deviation to put your stop limits around so you know how far the market could possibly extend. And that's when you get out. Yep, that's when you know you're definitely wrong with these levels start to be broken and the trend starts to change. So the real indicators that the overall trend has changed and that you have to reassess and revisit your trading strategy. So your entry. So again, when you're trading, the entry point sometimes is easier than getting out of trades, funny enough. But what we have to look at, as I've said before, that we look for points of attraction. So if we're looking to buy in an upward trending market, and we've got our levels of support in, then we need to be buying all along that level of support. So again, you don't have to necessarily buy it on that line, on that price, but look at the price action around it. If people try to break through the the trend line, and it doesn't go, this in itself is an indication that we're finding support. So we might have to get involved at any point after that line does its job, holds its support and bounces. So that's when we start to get long again. So again, that's your entry point. Now your entry point, again, it could be when we get towards the midpoint. Maybe you haven't seen a good enough bounce and you've not reacted quick enough, or you're waiting for extra confirmation. We're seeing, as we are, big moves, big volatile moves. The FTSE moving 2, 3, 4% a day. So we're trading the FTSE on the short side, for instance, and we see it start aggressively bouncing off levels of resistance, but we're not exactly sure for where to get in. Again, wait for the midpoint, see what happens. If it starts to bounce off the midpoint, right, then again, maybe the move isn't necessarily as strong as it could be just yet. So wait for it to go back up towards the levels of the resistance. And if it doesn't break through, then you get back in. Or if we see the midpoint start to be aggressively attacked and break through, then you get short again. Because again, because of your trend channels, that your levels of support on the downside should be equally apart. So you don't have to necessarily get in whatever you're not entirely sure and not entirely confident. All you have to do is get involved where you do see value, and it does tie in with your market view. It does tie in. You do have the confidence. So again, all the things you should be doing. When I've said to you in previous sessions, have a trade log. Maybe you see a pattern. Maybe if it's a selling market, you don't always get in at the very top end. Maybe you get in when we're at the midpoint, or we see the real volume into the market, and the real volume push the market with aggression down to our levels of support. Maybe that's how you trade. You trade around the midpoint, not the extremes of the market. But again, you need to know what you're comfortable with. You need to know what's worked for you in the past, and you need to know by trading these trend channels, what you're most comfortable with, what gives you the most confidence. So again, I mean, we're going to go catching bottoms using MACD. So again, this is where I said to you, you tie these trend channels in with other kind of oscillators. So your MACD, again, is just another indication of strength within the market. So if we're looking at this as a bullish market, so a market that's going up, could be anything, it doesn't matter. So what we do is, we've got our trend channel drawn in here. So again, we don't know what's going to happen in the future. That's unknown. But at this point, we've seen, yes, that was a level of support. Yep, now become a level of resistance. See a bit of a peek through, but not too much. And this is a good level of support. Bit of a peek through, but right. That's the basics of a trend channel. We like that, that's good. So we're going to trade against this. So we're going to catch bottoms because it's a rising market. Yep, we can tell by the angle of the trend channel. So we're going to buy at low points. Yep, we're going to start buying low. So there we go. As we see, don't have a midpoint in the middle, but we know roughly where the midpoint is. So again, we see on this first line here, our MACD is showing strength is coming to the market, a buying action. So what we do, we find our low point on the graph, right on that line, bang, great trade. Secondly, peak, the buying, low point on the graph, great trade. Even stronger peak in the buying action, yep, tie that in, low point on the graph, support's coming to the market, bang, great trade. Get out anywhere, above, well, on this line of resistance. Fourth opportunity, again, not quite as strong here, as you can see, it's been a bit of a lag in the buying, but again, indication from that, low point in the graph, self-fulfilling prophecy, the buying action actually catches up with the graph. Great trade. That's 4 opportunities to take on minimal risk with 2 indicators being your MACD and your low point and your level of support. 4 trades, yeah, 4 opportunities to make very good profits. Now again, you can tie this in. When I say don't be greedy as a trader, don't necessarily look, to buy, sell, turn and reverse and sell at the high points. Maybe, what's going to make you a more disciplined and better trader is recognizing upward trend, levels of support, good buying signals in your MACD, so we buy. Buy low, sell high. Buy low, sell high. That's 4 opportunities to make great money. Okay, and when you've got your confidence, you could even draw your midpoint in. You can even positive average, which means get more into your trade, double up on the trade. So that's 4 great chances to make money. From again, when we start back here, didn't have any information past here, so we let the trend channel do its work, do its job, and we see perfect levels of support, perfect levels of resistance. It's not always going to be this easy, but you might have to wait for these opportunities to occur. You might have to really be disciplined in your trading. But if you're going to look at that, trade your trend channel with your MACD and get them 4 opportunities to make really good money with taking absolutely minimal risk. That's the kind of trading I'd like to do. I think you'll agree. So your exit. So again, as we've said, your exit points are just exactly the same. Okay. So when you're in at a good point of support and an upward trend, your exit points are anywhere around levels of resistance, or your midpoint, or anywhere within that trend channel where you think you've taken enough. So always look for the midpoints to be your first level of where we hit, and then your opposite boundary is the point that you really should try and get out, or get some out, and then reassess, what's going to happen. Okay. All right, Mish. All right, glad that answers your question. So again, it works in the same way. So these levels, yeah, they give you your entry points, and conversely, because we've drawn them in, they already give you your exit points. I mean, they're not always going to work, but if you draw one in good enough, you're going with the overall trend, using other oscillators to back it up, then you don't get out until the midpoint's tested, and you don't really get out until the top end of the resistance is tested, or at least it looks like it's going that way. So again, it's not about being greedy, it's about being disciplined. It's just about getting in the right entry point and making sure you stay in the trade to maximize your profits. Yeah, you'd be absolutely amazed at how many traders I've worked with, over the years that get on side. The classic one is that people don't use trend channels like this. You get into a trade, you go heavily offside, they negatively average, then they get to a scratch, and they might take 5, 10 ticks profit. Absolutely ludicrous, the amount of risk to your capital, to your trading strategy you've taken on, then you don't fulfill. So if you take your trade 50 ticks offside, you should be looking to make 100 ticks on the upside. But using these trend channels and these ways, we're already involved at the extremes of the market. So we know these are safer places to get in. Now again, it's going to take time for them to reach the extremes of the market. But if you can be patient and wait enough, that means when you do get your entry point, you're going to take on minimal risk. So you can run that trade as long as you like within your boundaries, because you've earned the right to be in. You've been disciplined. You've waited for the right time to trade. So again, sometimes the less times you trade in a day is going to make you a better trader. So again, it's all about discipline, using the extremes of the market and finding the places, where you've really picked out that juicy entry point. And once you've got that perfect entry point, you're looking for the perfect or the best exit point you can do. Now, this won't happen within 5 minutes. It might not happen within 15 minutes. But you've got your midpoint, you've got your upper end of the market, so you've got to sit it out, you've got to be confident. The more confident you are, the more times you're going to hold these trades, and the more times you're going to really benefit from, profit-wise from holding these trades. So again, when I talk about scaling in and scaling out, and averaging in and averaging out, I'll just explain that, because that's a trader term. So when you scale into a trade, this again means you can put some initial capital, your initial trade on at the extremes of the market, and then if it starts hitting the midpoint and you think the overall trend's going to go, then maybe you start to scale in. You build a bigger position in, going up towards that midpoint, and then hopefully it's going to break through and go to the upper end of the market. So that's called scaling in, positively averaging in, because you're onside, putting more into a successful trade. The opposite of this is scaling out. So when you can put your trade on initially, maybe we get towards the midpoint, we take some profit out of the midpoint, then we try and run the rest of the trade to the upper end of the market again. So we've already taken some profit, guaranteed that, then we've seen the rest of our trade continue up to the top end of the market. So that's scaling out. Now when I talk about averaging in, that's exactly the same. But positive average is when you scale in, when you're onside, and negative average is when you go offside. Now I don't recommend you do this as traders, unless again you're using methods like this. So if you're using methods like this and your trade, say you're buying at the bottom end, and then it starts to break through that channel, then maybe it bounces all the way back to your other levels, like we saw, so maybe your RAF line. So maybe when you're offside, you buy more at that point, so more at a better price at that RAF line, and then they go all the way back to within the channel, so if you know what I mean. So what you're really doing is that the trade is good, but it might be pushed for whatever reasons in the market. Maybe big traders come in, maybe there's been a little bit of news, but we know the likelihood is it's going to only go as far as that RAF channel. So we stay in the trade because we think we're right. We buy more at a lower price, even though we're offside, and let it go back into the into the channel. So it's not easy to do. I don't recommend you do it. But what I'm saying is, if you've got finite points within within your graph or your chart that you've drawn out correctly, and you know how far the markets could be extended, then there's nothing wrong. If again your capital will allow it, and you're confident enough to buy when you're offside at them levels, and then you've bought even more at a lower level because you're pretty sure it's going to go back within the standard error, the standard trend channel we've originally drawn. So again, just different styles, different ways of trading. Again, you have to be very, very confident with your style. So don't try and mix and match styles. If you just want to buy at a price, sell at a price, that's fine. You're going to scale in, when you're on side, that's fine. Trade however you want, however makes you confident, and more importantly, however makes you the most money. Because different trading styles, are as individual as everyone's trading strategy. But as long as you've got the right entry points with this method of trading, you're always going to have a clear and defined exit point. So again, this is another example. We've got a midpoint, levels of resistance, levels of support. So this is just different ways of trading. So again, upwards trend, we get in, okay, maybe our MACD is telling us low point, bang, let's get long. So what we do, we get all the way to our point of our midpoint, so maybe we increase. We see it come up, it doesn't really test, maybe we get some out here, but we come back right back to our midpoint, so maybe we increase. We double up our position, bang. Trade again, goes all the way to the top end of the lines of resistance. Skip on. to our line of resistance here. But again, that's different ways of trading. We might hold the trade here, go all the way here, see a bounce and get it out here. Or we might get some out here and double up here. Or we might let it bounce here and double up again. It's all different ways of trading. But we've got our entry, we've got our midpoint, which we know is going to act as a level of resistance and support, and we've got our exit, the top of the trend channel. If you tie these in with all your other key levels and your overall view of the market and your research, these again, it's a very simple but very powerful way to trade. And you've got your entry, you've got your initial point of interest, which is your midpoint, and you've got your exit. So again, if we're looking to trade, we're looking to take the fear and pain out of markets, this is a great way of doing it. So capital management. Okay, now this is very controversial, very personal to every trader. Now, the rule of thumb is you commit 1 to 2% of your capital per single trade. Now, when the markets are as volatile as they are, again, you have to build this volatility into your trading strategy. You have to build into capital management. Maybe because the markets are so volatile, you're going to be trading less, so maybe you have to commit 5, 6, 7% of the capital for every single trade. Again, you have to write logs, you have to know how much capital you've got, and then assess your trades to see if that's working out for you. So, again, it's all very personal to you. We all know how much money we've got in our account, we all know our attitude to risk, and we all know how much we're comfortable putting in each trade. So again, you're going to find some happy medium with that. If you're writing trading logs and journals down, then you're going to be able to assess and go back and say, right, last week I traded 7% of my capital, and I made 7 out of 10 trades, winning trades. Brilliant. Okay, that's working. Or you go back and you say, I was using 2% of my capital, it was 50-50, winners and losers, I didn't make any money at all, really. So again, maybe, these kind of figures will allow you to trade less, or some points trade more. Maybe you only trade after figures. Again, you just need to know, you need to figure out, that whatever your starting capital is in your trade, that you're using it effectively. There's no point having £10,000 in your account and trading, minimal size, because, you're not utilizing the capital you've got. If you're just putting very, very small size and getting in for a little profit here, a little profit there, then what confidence are you going to have in your trade? What confidence are you really going to have? You're just almost like punting. But if you have £10,000 in your account and you say, right, on this trade I'm going to make £3,000, I'm going to risk £1,000, 10% of my capital. You're going to pay a lot of attention to that trade, and you're going to be very, very kind of sure when you get into that trade that's the right trade, because you know exactly what it's going to cost you. So sometimes trading bigger is better, because you make sure every trade you do is for a reason. Trading small size, there isn't as much fear. So you can say, well, I'll tell you, I won't stick to a risk strategy. I'll let that go another 5, 6 offside. It's only another £10. What does it matter? Of course it matters. These rules should be exactly the same whether you're trading £1 or £1,000, right? Until you can get to that point, that's what's going to give you, the confidence, and that's what's going to make you a good trader. If you can treat £1,000 trade the same way as you can as a pound trade, right? I'm not saying it's easy to do, guys, and it takes a lot of time. But if you can build your rules that support you on these pound trades, no reason why they couldn't support you on higher trades. So that's the aim of trading. That's what we're trying to get to. So again, using stops. So again, as I said, this is the way of using stops. You put your trend channel in, but then you also, you can have your RAF channel or your standard deviation around it, or maybe just other key levels. So we've come through here, this midpoint. We've seen a bit of a head and shoulders pattern emerging here. So necessarily you'd expect the market to go down from here, but we don't. We see a big spike up. So again, that could be a big trader. That could be a black box, a grey box trying to push everyone out, but you don't get out until the level of support's hit. So maybe again we see it going all the way up here and think, well, bang, this isn't right. We've got our indicator saying we're coming to a selling section. We've got a head and shoulders pattern. We're in our trend channel. So why is this just spiking up for no reason? So maybe until it hits our level, don't get out, sell at a higher price, and then bang, market comes all the way down to here. But again, this is all, you have to base your stops around whatever you're comfortable with. Remember, these standard deviation channels, error channels, things like that, they're all mathematical formulas. So because of mathematical formulas, people in the market know how far they can push you, because they know how far offside can go before you get stopped out on these levels. So you have to, You have to set your risk reward, set your stops, set your monetary kind of, your capital allowance around all these things. Because remember, we're all looking at the same thing, and people know where they can push the markets and where people's pain threshold is. And that's very important with the psychology of trading. Remember, you're trading against other people. Yep. So if you're trading here short, the likelihood is the majority of people are going to go trading short because that's what the indicators say. And that's when people can come in, try and manipulate the market, push it through. Yep. So everyone gets out, they get filled, and they go, right, yes, we know the market's going to go down, so we'll just let it go down. And bang, what everyone thinks is going to happen actually does happen. But they squeeze people out of all these positions, take a nice short one, and let the market do exactly what everyone thought it was going to do. So again, remember, you're trading people, and you have to take your stops and take your cash management around what other people and what they can afford to do in the market. So trailing stops. So again, this is just another way. I mean, trailing stops you can use when you're onside. So basically, if the market does start to come back to you, you can get out for a scratch or you can get out at a profit, if you're onside enough. So trailing stops are a good thing to use, especially in these scenarios, because what that can do is, if you're onside at the high or low of the market, you put your stop in maybe halfway between the midpoint and your initial entry point. So what that's going to give you is that, we're going to aim for the midpoint, we're going to aim for the upper end, but if it comes back to us, we get out for a profit, then we can reassess and get back into a trade. But hopefully, using this method, we see it hit the midpoint, so it doesn't really come back, as far as our stop, and just continues. So, that's taken all the fear out of the trade, it's taken all the pain out of the trade. So unless you get stopped out, or it hits the top end of the market, they're the 2 points when you get out. So if you're trading this way and use trailing stops, that can take a lot of fear out of the market for you. Because again, you're going to get stopped out for a profit, which is the one thing, or it's going to hit the top end, so you've made the most out of that trade. So that's another way you can use trailing stops to help you within trend trading. It's going to take the fear out. So put my stop in, I'm guaranteed to make 30 ticks, 20 ticks or whatever, and if not, I'm going to make 70 ticks, it's going to hit the top end of the channel. So, I mean, that's great. So it can move around all it likes, it can be as volatile as it likes, but until you're stopped out of one of these two positions, you've taken all the fear out of it. All the fear's out of that trade because you know your two exit points. So that's where trailing stops in this scenario can be very, very powerful. So you limit orders. Now again, I mean, limit orders are a very personal thing. To be honest, when I trade, I don't use stops, which isn't to say, they're not justified and they're not good for, for people who are learning to trade or people that are fairly new to trading, right? Well, all it does is it gives you, a target that should be set, which, it's a finite order. So you say, if the market comes to this point, I'm out, regardless. So again, if you put limit orders in, that's good because it's showing discipline. Yep. And again, don't look at it as a losing trade. Look at it, you've paid for that information. If the market's got to that point, you've been stopped out, you've paid to know the entry point wasn't correct, and your view on the market at that time wasn't correct. Not to say in the future it won't, or the next trade it won't. But for that particular trade, it wasn't right. So you're stopped out, your limit order should be set on a number of ticks, or set it as, a physical amount of money you want to lose, or you're willing to risk to make that profit. So that's the way you've got to look at it. It's all about the terminology you use. Don't look at it as losing money. Look at it as the amount of capital you're willing to risk in order to make X amount of ticks. So a bit of a summary. So what we can see is, we've got our midpoint, upper end, levels of support, and again, what we can go through is we've got a key level here. So we see, right, some big bottoms here, right, so that's our stop. So for whatever reason, if it gets below that level, we're out of the trade, we're wrong, we've got the wrong view, our trend channel's not working. But as we see, if you put your limit order in, yep, and then you get your trade, you get kind of, get long here, take a little bit of pain here, because we just break out of it, but we don't go through our key level of support, our out point, then bang, all the way to the midpoint, then all the way to the top point, to the midpoint, bang, we even break through the top end, yep, but again, that's a perfect example of we put our stop in here and we could hold that trade as long as we like. Yep. Even if we put our stop in here and walk away for days. Yep. We never get stopped out. Yep. The market continues to rise upwards. So we could get in here and get out here. That's one way of trading. So we've made all that profit, but there's been all that noise in between. So if you're watching your screen, you'd be turning your hair out, you wouldn't know what to do. If you put your stop in here, your entry point here, Then you walked away till it was here. You've taken absolutely no pain. It doesn't matter what the market's done. Who cares what the market's done? It's just done what the market's done. You put your trade in, you put your stop in, then you've made all that profit. But again, you know, we're a bit more proactive. You know, we're watching the market, so we're being a bit more proactive, a bit more smart about it. So we get long here, midpoint, maybe we take some out. Okay, the market's trending. Yeah, it's broken to the midpoint, so we're still long. That's good. Right at the top point, right, let's get out. You know, that's a good profit from there to there. Okay, the market comes back to the midpoint. Ooh, a bit of a breakthrough. Oh, right, back at the midpoint. Okay, midpoint, good. Let's get long again. All the way through, great, another great trade. Then maybe we're thinking, well, you know, the market's pushed through, but it's not really kind of, you know, showing any kind of continued buying bias. So maybe here, that was a good place to sell. Bang, to the midpoint, to our low point. However you interpret it, it's just giving you, that's giving you 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 opportunities in that time scale to trade it however you want. Yep, because you've got your midpoint, you've got your high point, you've got your low point. So again, you do your initial trade, put your stop in here, bang, make all that profit. Or we trade within the trend, around the midpoint, around the extremes. Yep, so buy, sell, buy, sell, buy, sell, buy, sell. Now, I'm not saying trading is going to be that easy, but that's giving you 5 or 6 clear opportunities to stick with our risk reward, to stick within our plan, and to stick to our style of trading. That's 6 opportunities just by drawing in these 3 simple lines, you know, to trade an upward market. Okay? So again, it's something else you can just build in, and it's going to give you the confidence to A, get in the trade, B, stay in the trade, and C, have a really good idea of where it's going to be, where it's going to go, which is going to be the top end of your trade. Okay, guys, well, a bit of a summary. So, I mean, it's a well-known and trusted technique, right? I've used it, traders have used it, big banks use it. So again, it becomes self-fulfilling. So again, choosing the right kind of channel is crucial. So again, if you're drawing it free, you know, just by drawing lines in, be very, very careful. Make sure they're parallel as they can be, and you know, they do it at the same angle. So again, you've got to choose your entry point carefully. Only get involved in the extremes or the midpoint. Yeah, don't get involved anywhere else. And if you've missed it, fine, you've missed it. Right, wait for your next point. Yeah, if you missed it on the low side, wait for it to get to the midpoint and see what happens. Then either buy or wait for a small bounce. Yeah, so get involved in the extremes of the market. This may mean you trade less. That's not necessarily a bad thing, because when you're patient and you wait for the right opportunity, the right indicators, that's when you get the confidence, and that's when you put your size on and you do a really good trade. So use, you know, your limit orders to avoid unpleasant surprises. If you do want to walk away, yeah, and just let the trade continue doing what it wants to do, and use your trailing stops to give you that confidence to stay in the trade, because you know no matter what happens, you're going to have a winner. All right, guys, I've done a lot of talking today. Hopefully, you've enjoyed that, and you know you really kind of got some benefit, and you can build it into your trading strategy. Then, I've got any questions about trading channels, or any other questions about trading. As always, I'm going to put my email address down, because I know people don't always like talking on the live chat. So if there's anything you want to speak to me in private, send me an email. I'll do my very best to get back to you as quick as I can. Now again, we're going to do some more live trading. We're going to try trade Philly Fed on Thursday. The presentation will start at 3 o'clock. So again, we've had five winning trades so far. So we've made some good profits. If you want to sign up to that, just follow the link that's on your screens now. Philly Fed moved the markets considerably last month. Not necessarily sure it's going to move the markets that much, but again, it's a different figure to trade. It's again, I'll show you the techniques, show you entry point, how you manage an onside, offside position, all that kind of good stuff that you know, that's going to give you the confidence to get involved in these figures and trade. And like I said, you know, I'm significantly in profit, so it's not, as I've always said, it's not a line of, it's a line between arrogance and knowing that I'm prepared, knowing I've got, you know, I'm going to trade on my rules. These are the things that hopefully I'm going to be able to pass on to you guys, and you know, make you successful, even more successful traders. All right, Michael. Well, great. Well, again, I mean, I'm going to be writing some new material at the minute, so we're going to get slightly more technical. I'm going to really delve into the psychology of trading, how you keep on-siding trades. I'm glad you're reading the books. Always very important. Yeah, and watch different seminars because everyone's got their own take on trading. You know, mine is just one particular view. So again, I'm actually going to be featured on FX Street in the coming months. So you can watch some perhaps new presentations then. Like I said, I'm going to get a little bit more technical, and I'm going to really kind of get into the nitty gritty of trading. But great, Michael. I'm really glad you're enjoying it. That makes it all worth it for me. Okay, Si, did I first learn by paper trading? No, Si, to be honest. I only ever lost when I paper traded. When I first started professional trading, we had a simulator, which is just like paper trading. I couldn't make any money because I didn't have the commitment. I traded small. I'd just get in and out. I didn't really kind of look for any overall trends. I was just looking at the money. So I find paper trading quite harmful to the way I kind of thought and where I'd looked at the market. So when I did start to trade live money, I traded even bigger size. I traded very infrequently, and I started to make money very, very quickly. But it's different for everybody else. I paper trade when you first come into trading to learn the basics, price action movement, how to interpret graphs. But the sooner you get into real money, the sooner you get that emotion and deal with that, that's what's going to make you a good trader. So very, very dangerous paper trading. It can give you a false level of security or even insecurity if you don't make money paper trading. You think to yourself, how will I ever make money live? All right, guys. Before you all leave, let me just put another poll up for you. Just please, give me your honest feedback. Tell me how you found it today. As always, I'm very, very interested to know your guys' opinion. Hopefully, these things are all adding to your trading strategies, your confidence levels, and these are all things you can take away and implement. So again, please send anything through and you'd like to hear, like me to discuss with you to my private email. Follow the link for the live trading session. There will be a night session on Thursday, so you can tune in for that. But we'll be trading fully fed at 3 o'clock. Actually, 3:30 is going to come out at. So I think tune on from 3 o'clock. But you should have an email about that. So again, it's been an absolute pleasure again this afternoon speaking to you guys. I think it's been a very, very positive session. Some brilliant questions, especially from you, Si. That was excellent. All right, guys, have a great afternoon, and hopefully I'll see you on Thursday. All right, good afternoon.